Welcome to my Monday Business 100 class. This is Professor Mayers. What I've got is a brief presentation that I wanted to give you that's going to summarize the key learnings from chapters 17 and 18, which are accounting and finance. And really what this does is lets a corporation or a company take all of the financial information that takes place over a period of time and A, record it properly, and B, then be able to act on it or use the information to make business decisions. So really what this is going to cover are those two things. It's going to give you some tools to help you do that. And to do so, what I want to do is to start talking about these. I want you to think about monthly planning or your monthly financial planning, your personal finances. And I want you to think about if you're keeping track of your finances. And once a month, I sit down and I do some planning where I look at the expenses coming in, how they compare to what I expected, the money's going out, or the money coming in, the expenses going out. And I take a look and I start to make decisions of discretionary things that I can do in terms of investment, in terms of paying off some future expenses, savings, and things like that. But really what it starts with is I keep track of it, have a place where I keep track of. I have a place on my desk where I'm keeping track of all my monthly financial information. There's a number of things that go into that. First of all is paychecks. I'm going to keep track of some place where I'm recording all of the revenue that I have coming in. And that's, I know, the first of the month. In some cases it's bi-monthly, but first of the month my paycheck's going to come in. I know that I can expect that. Another thing that I can expect is halfway through the month, my credit card statement will come into as well, which will summarize key expenses that I have taken on over the course of that month. Now, in addition to those easy to plan things, a number of other things will happen. I'm going to be spending and bringing in money at different points during the course of the month, perhaps daily. I might have cash that I receive from somebody that I loan money to, or from change that I get from something. I might have a bill's going to come in. They're going to come in at all different times of the month. I'm going to make an expenditure, so I'm going to realize an expense of some type or another. Maybe I go to dinner, maybe I buy something at the store. And these things are going to happen steadily over the course of the month in various permutations and combinations. And I have a place over the course of the month where I keep track of all those things. So first of all, during the course of the month, these things are all going to happen, and I'm going to tend to sort them chronologically, meaning over time. So each day I try to keep a folder, keep them in time order of when they happen. The second thing that happens that I'm going to do then is that once they're sorted by date, is I'm going to organize them, meaning I'm going to organize them into a couple of different accounts or buckets, shall we say. The first one is it's going to be income related. I had paychecks coming in as well as other cash that's in my wallet that I've received over a period of time. I might also create some expense accounts, meaning I might summarize my credit card statements, which are more personal expenses, as well as I might add up all the bills, which represent utilities and other things I got to pay the month. So I'm going to keep track of the transaction that comes in over the course of the month, and at the end of the month, I'm going to create a couple of different accounts where money's coming in and money's going out. Folks, that is essentially how the general ledger system works. There's two ways a general ledger is recorded. First of all, in any business, someplace there exists a general ledger where somebody's recording every single financial transaction. An accountant is recording every single financial transaction that's taking place, all the cash that comes in, revenue from different places, expenses going out, etc., and it's recorded by date and then coded, of course, by type of income or expense. So someplace the general ledger exists. It's going to record by day and by time all the expenses that took place over that month. At the end of the month, or after a certain period of time, the other thing that's going to happen is that general ledger is going to be taken in chronologically and then broken into accounts. I'm going to create income and expense accounts. Now, with each one of these for a big corporation, there's hundreds, if not thousands, of different accounts they would go into under either income or expense. But simply stated, that's what it does. A general ledger is just a record of, by date, all of the financial transactions that take place for that company. And then at the end of that period, they're posted into different accounts so it can be tracked and recorded. Now, This fundamental understanding of a general ledger is important, but really what it does is it then builds on how it feeds the other three key financial statements, which are, first of all, the balance sheet, which records assets and liabilities. Secondly, would be an income and expense statement, which over for a specific period of time to show profitability. And thirdly, would be cash flow statements. So the general ledger is going to then feed each one of these other statements. Now, how do they work? And this is important to understand. And think about them in three or four different dimensions. First of all, with a balance sheet, is really going to tend to measure more of a long-term perspective of the health or viability of a company. Income and expense is going to be profitability or intermediate term, meaning for a quarter or a year, and cash flow really is going to be short-term, weekly or monthly. So while all of these are done for a specific snapshot in time, think about how they're used. And as I said, a balance sheet more long-term, income and expense intermediate, cash flow short-term. Now, the types of what you'd find on them is, first of all, in the balance sheet would be a more detailed description of all the debts, like expenses that need to go out, or bonds that we owed, or loans that we've taken out, as well as the assets. So it's going to be detail on the debts and assets of the company. The income and expense is going to show, or is going to, what you'd find in there is the profit the company is going to make, the revenue that's on there, and the percent margins that they're making on the different expenses. Cash flow is really going to be focused on the timing and availability of that money. In terms of specific examples, you might find on the balance sheet accounts receivable, specific securities or portfolios that are owned, as well as the balances on different debts. Profit and loss statement is going to include the revenue, cost of goods sold, which means the variable cost of manufacturing a given item. Like I think we talked earlier in the semester about the variable cost of manufacturing a soft drink, a bottle of soft drink. And then EBIT, and EBIT stands for earnings before interest and taxes, which is a fundamental measure corporations use of profit. An example for cash flow then would be of what it would, an example is cash available at any point in time. And then lastly, what it's going to feed, what it's going to be used for, or an example of what it's going to be used for. So the balance sheet is going to be used to not just to measure the kind of leverage that a company has, how much debt that it has, and its different debt and equity ratios, but it's going to largely be used for security analysts to be able to draw a comparison between that company and others in a similar industry. Secondly, a profit and loss statement is going to be, in addition to it being an evaluation of profitability of a company, would be used to calculate how much taxes are owed for that quarter or year. And last but not least, cash flow is going to be used for things like line of credit planning. I may have plenty of money for over the course of the month to meet all of my financial obligations, but if my revenue doesn't come in until the 20th, but my employees get paid on the 10th, I have a cash flow issue. I may have it fine, maybe fine for the month, but I need to know that I need to use a line of credit to borrow some money for a few days in order to pay those expenses based on the timing of when things are going to come in. So, to kind of summarize how these work, the general ledger is a record of all of the things coming in, tracked by chronology, which then posts it to different accounts. And from those accounts, it feeds these three important financial statements: balance sheet, income and expense statement, and a cash flow statement. In addition to the material that you see here, I'm also going to post some other information for you, which will go into a little bit more detail, which I think will be important to your overall understanding, but I think this does give you a good start. Please respond back and let me know if you have any questions on this, and if not, I wish you all a wonderful Thanksgiving, and I will see you next week.